Hey, welcome to Grant's Interest Rate Observer of the Air. I am Jim Grant, and with me, as always, Eric Whitehead at the controls of this enterprise here, this podcast, and Phil Grant across from him. Phil Grant is the proprietor of Almost Daily Grants, the must-read daily summary, almost daily summary of the markets and their wiles. And across from me immediately is the great deputy editor of Grants, Evan Lorenz. So, gentlemen, welcome, and ladies and gentlemen, welcome to Grant's this episode of the Grants podcast. I want to give a shout out to the listener who was walking at the east on West 52nd Street yesterday. It was about 6:45. He passes me. He's wearing earphones, and we pass. And you know the way you can tell if somebody is stopped, even when you're not looking, and stopped and turned around, going to say something. Well, he stopped, turned around, and said this. He said, "Hey, I'm listening to your podcast right now." Yeah. So that reminds me that it's time to do a darn podcast.
That guy's got good taste, clearly.
Yeah, here we are. So today we are going to talk about some of the following things. We're going to talk about the future, of which nobody knows nothing. We're going to have a special July 4th message. We're going to ruminate on the readings having to do with cash to debt in leveraged American companies and record share buybacks. We're going to talk about cryptocurrencies and China and the future. As I said, the future about which nobody knows nothing. Now, the future to begin with, the future is a somewhat sensitive topic around here because we deal in it, yet it doesn't exist. Now, Eric, right here, is something of an authority on the future. He has been, as you know, regular listeners, Eric vacations only in communist countries. It's something he does. He goes to Cuba, Vietnam, and as you have also heard, he has and his family have reservations at the flagship Days Inns in Pyongyang next February. Not one of these crummy, Beltway Days Inns. The main
one, the best.
The main one near that 50-foot high lead statue of Kim Il Young Suk.
Right.
Yeah. So Eric has seen into the future and has identified North Korea as an investment opportunity, apparently. But Jimmy Rogers was in the tape just yesterday saying that North Korea is the great play, and he's going to do it through South Korea. So Eric, you're a little different. You're going to go directly to North.
I hear it has really nice beaches too.
Yeah, but not in February so much. No. So Jimmy has this vision. Eric has a vision. But it occurs to me, man, that we were writing this week about this extraordinary binge of borrowing by some American companies, including AT&T, which is on the verge of showing $249 billion of debt, including off-balance sheet obligations and pension retirement stuff. And it occurs to me, Evan, that the rolling up of that kind of debt is a tacit assertion of foreknowledge. They can see into the future. They can see that's going to work. And leverage is an expression of overconfidence in our financial future.
I agree. They're looking past the present because I believe on a pro forma basis, MoffettNathanson's shows that their EBITDA is actually contracting. So they're seeing a brighter future than they see today.
Yeah. Well, we'll see about the future in the fullness of time, I always say. Well, no more than 10 years. But I wanted to get, let's keep going because we have all sorts of things to discuss. Oh, I forgot to mention our sponsor.
Who?
The sponsor happens to be Grant's Interest Rate Observer, which, to be sure, is a somewhat self-interested transaction. But this comes from Eric, our seer and investor. Eric came up with the idea of let us offer, he said, a Grant's trial subscription to the listeners of the podcast. We do it through other channels. So let's do it. All right, Eric, it's a good idea. So here's what you get. 6 issues of Grants, plus a signed copy of Ahem, my latest book called The Forgotten Depression, which is okay, I'm going to ask you employees, is it not a fabulous,
wonderful,
eloquent historical narrative of the last governmentally unmedicated business cycle downturn, 1920-21? Does it not ring that particular bell?
I think it's
fantastic.
Yeah.
So my son agrees with me. My immediate deputy editor says, yeah, Eric, it's Eric.
Unanimous.
Yeah, so you have to read the darn book. And to do that, all you got to do is subscribe to a 6-month trial, or a 6-issue trial, sorry. And to do this, you go to www.grantspub.com/pod18. That's grantspub.com/pod18. That's, okay, I didn't mention the price. I couldn't because I was so embarrassed at how little it is. $349 pathetic US dollars.
You're giving it away.
For 6 issues. A signed copy of The Forgotten Depression. So well done, Eric. And thank you for your confirmation of the merits of this book, man. And for you, ladies and gentlemen, please do avail yourselves of this July 4th opportunity. And speaking of July 4th, before we get into China and cryptocurrencies and stock buybacks and debt. I want to read something. This is a July 4th themed message that comes to us from Thomas Jefferson. And I'm reading from the Albert J. Nock. That's N-O-C-K. Very quirky and very excellent biography of Jefferson. Came out many, many decades ago, I guess in the 1930s. But here is Jefferson writing to a friend of his about what he proposes to do in the early phase of his first administration, which began in, I guess, 1801. So here is what he said. Jefferson said to a friend that the path we have to pursue is so quiet that we have nothing scarcely to propose to our legislature. A noiseless course, not meddling with the affairs of others, unattractive of notice, is a mark that society is going on in happiness. Boy, I love that. All right, that's July 4th. Happy birthday, America. However, that's not getting us closer to China, Evan.
It is not.
China, Evan is the Grant's interest rate observer sinologist, and I want to know what you think about this, Evan.
Well, I know what the market thinks because the Shanghai Composite Stock Index is down 20% from its recent highs. The renminbi is down 5% against the dollar from its recent highs, and key commodities that are tied into China's growth model, like iron ore, down 20% plus from their recent highs. Everyone sees China's activity slowing. It's the economy still growing, but activity is kind of paring down. New loan growth is actually falling year over year. But there's been an important change the other day. The China's central bank, the People's Bank of China, recently came out with a report that kind of signaled that they might actually be less focused on deleveraging and more focused on growth again. China, if you haven't followed, has exactly two modes of managing the economy. One is mashing down on the gas pedal until it hits the floor and then kind of, allowing a bubble to blow up. And the other is mashing on the brakes and trying to undo the damage they just did when they, accelerated haphazardly. But the new PBOC governor, Yi Gang, is now signaling that growth is more important than a crashing economy, a crashing stock prices, and everything else.
That's just like a central banker.
It is like a central banker, but unlike in the US, where we worry about like a wealth effect if the stock market falls too far, in China, it actually has real economic repercussions.
Why is that?
Well, a lot of companies have trouble borrowing because they may not be persona grata for banks. Like banks are not supposed to lend too much to property developers. So they get around this by pledging their shares. Either the founders do or the companies do. And there's something like 5 trillion renminbi of shares pledged for loans. And as prices plunge, brokers want to call in these loans.
So these are called margin loans in the West.
They are margin loans, but it's not investors who are, pledging shares. It's the actual companies themselves. The PBOC has intervened by telling brokers, if you want to sell shares, you're going to need to get our permission first. And, that permission is probably not going to get too easy. But they don't want the stock market to fall further. They don't want the economy to crash. And they also don't really want to deal with the repercussions of a trade spat with Trump. So it looks like China might be on the verge of switching from trying to pare back some of the excesses that they built up over the last couple of years to re-stimulating and trying to push growth forward. The question
now, is this speculative, or how hard is this perception, or how clear is the perception?
It's mud. I mean, you really can't tell for sure. We'll find out in the coming weeks and months as we get more data. But with China, it's just hard to say. The data's not good, and we'll see when it happens.
Sometimes they, that all-purpose pronoun, don't really have control. Evan is in the current grants observes that Chinese M2 is almost identical in size to the combined money supplies defined as M2 of the United States and the Eurozone.
That's true. So China M2 foots to $26.5 trillion or 2.2 times Chinese GDP. And the US and Eurozone have M2 of $27.8 trillion. One problem that China's had in the past is when people view the domestic market is not a great place to invest, or they're worried about devaluation, they kind of decamp en masse outside, and that leads to a tightening of liquidity and a financial crisis. We actually saw this in August of 2015 when the PBOC did a shocked evaluation of like 2 or 3%, and that 2 or 3% was enough to actually change perceptions and cause money to fly out. It led to a big crash in the S&P 500 in commodities and just about everything.
Well, I mean, the renminbi against the dollar is down by more than 5% from the highs of a few months ago. Right, that hasn't yet at least caused such a reverberation. It
hasn't. Since 2015, the other thing they've done is they try to put up more capital controls to make it more difficult to get money out. However, Chinese investors and companies are pretty savvy people, and they'll find cracks if they really want to get out. The other thing is China's banking system has just gotten so huge after so many successive years of stimulus. It's now $40.8 trillion. It's 51% of global GDP. There is no precedent for any banking system getting this large ever.
Well, the Icelandic banking system, with respect, as a proportion of Icelandic GDP, was certainly quite chunky.
Yeah, it got to like 8 to 10 times, but Iceland's a country of 300,000 people.
Wait, let me get this straight. You're saying that Iceland is less significant than China. Is that it?
More significant if you're into cod, more significant if you're into beautiful beautiful landscapes and volcanoes.
And they're a better soccer team, too.
They have an amazing soccer team.
Well, that was a nice save there on your part, Evan.
But China's a $13 trillion economy. Yeah. It's the biggest consumer.
Well, in fairness to to the situation, we have been expectantly watching China expectantly, with figuratively speaking. Now I'm just getting tangled up with hands over our ears and eyes closed, waiting for the crash for years.
We have. And the thing is, China always seems to be able to pull itself up. In 2009, they basically issued new loans that were like 40% of GDP at the time. Yeah. In 13, it seemed like there's a little crisis, so they mashed on the accelerator then. In 15 and early 16, they massively stimulated, and that kind of bailed out emerging markets in the commodity sector.
But with every bailout, debt becomes more
larger and larger. The financial system gets more and more bloated. It gets on more precarious footings. At one point, it's going to topple. When that is, it's hard to predict.
But
just one follow-on on that is that if you look at the credit impulse, Chinese credit impulse, with each of those reflations, those stimulus attempts, the effect has been increasingly less each time. In 2009, it was the biggest change.
Yeah, diminishing returns. Way back when, and during the 1980s, this publication sang the same song with respect to Japan, which is, I think the metaphor we used was Japan is like an anvil suspended over the head of the world economy on dental floss, if memory serves, because China's banking system was distended and the credit quality was obviously precarious and unsound. These banks were chock-a-block full of speculative real estate debt. Japan, rather, did suffer a banking crisis and did suffer a deflationary hangover that still has not yet passed. China is much, much bigger than Japan was in absolute terms and as a percentage of the economy.
And not as a percent of world GDP. And actually, 92 and 93, Japan was, I think, 17 or 18% of. It was a larger portion of world GDP than China is today. China's a much larger consumer of global commodities than Japan was.
But as a percentage of world GDP, Japan was larger in the 1990s.
In the early 1990s. Yeah. I need to get the exact numbers, but Japan was larger. There's puts and takes on both sides. Japan's financial system is much larger than anything that Japan ever had.
No, China is
much larger than anything Japan's ever had, either in both in absolute terms and relative terms. China's a much larger consumer of global commodities than Japan ever was. It's a much larger population. But on the other side, its financial system is largely inward looking. If its financial system crashes, it's not clear what the direct impact is to the rest of the world, other than a big decline in probably commodity consumption.
I don't know. It seems to me China is consequential enough such that an internal crash would be a very worrisome event for everyone. It's hard enough running a financial system when information is unfiltered and free, if sometimes unreliable in its accuracy. How much more difficult in a society in which information is controlled from the top and distorted willfully for the purposes of policymaking.
So the other week, it came out that the year-over-year change in fixed asset investment in China was the lowest it's been since the series created in the late 90s.
6%.
Yeah, 6% or 6.1%. Goldman Sachs apparently came out and said, don't worry about that. What they're actually doing is adjusting for the fact that the data was bad years prior, so they actually needed to adjust down the number. But the real activity is okay, just the data's bad. But other bad data is showing, good activity. It's just...
Yeah, well, it seems to me that's Goldman Sachs a little bit too conversant with the techniques of securities price manipulation. So we'll let that one go. But I would expect a little bit more moral outrage from the leading lights, shall we say, of the sell side. But Phil, you came across something today that I thought was striking in its symmetry. It has to do with share buybacks and with cash and debt. What are those facts?
So some data that I saw in a recent CNBC article that corporations in the U.S. hold the lowest ratio of cash to debt. I think the 12%, which is the lowest in quite some time. In the 2014, that ratio reached 14, and we have exceeded that in terms of greater corporate leverage. And so while that's happening, the first quarter stock buybacks among U.S. corporations reached a record high of, I believe the figures, I don't have it in front of me, I think it's $189 billion.
Yes, yeah. 189.1.
So while cash levels dwindle, stock buybacks percolate with the market at virtually all-time highs. So
the stock buybacks, it says here, according to the Associated Press, reached $189.1 billion in the first quarter, and that compares with a prior record of $171.9 billion set in the summer of 2007, that fateful fateful summer. Of course, the market's much bigger than it was then. So still, we can agree that a lot of stocks are being repurchased in the open market at
high prices.
Very fancy valuations. Yeah. So I don't know. Have we got everything off our chest, man? What do you think? Evan, I don't think we've heard from you about cryptocurrencies. Evan is the responsibility for many areas here at Grants, and phony money is one of them. So Evan, will you tell us please about?
Yeah, I'd like to start by a headline in Bloomberg today. Bitcoin bloodbath nears .com levels as many tokens go to zero. And the article goes on to note that Bitcoin is down 70% from its December highs, and hundreds of other coins have virtually gone to zero. The Nasdaq Composite in the .com crash actually fell 78%, so its crash is almost as big as it. Now, there's been some negative news in Bitcoin lately. There was 2 South Korean exchanges that got hacked. Japan is actually tightening up regulation, but that's nothing new in Bitcoin because...
On the other side of the ledger, Evan, Facebook is now allowing a little bit of Bitcoin advertisement. Although, but the Wall Street Journal and the Heard on the Street column is a very excellent column in the Wall Street Journal. An item yesterday, I think, about how about this Facebook decision. It's going to allow some advertising for the cryptos. And the author of this item said, well, that may or may not make a difference. The only monetary asset in the world in which you see advertising is gold bullion, which has been which has not distinguished itself for the...
I've actually seen advertising for the ETFs too, so I don't know what that says about them.
Yeah.
No, but the interesting thing that we've learned this month is something about Tether. Now, Tether is something they call a stable coin. Each Tether is supposedly backed 1-for-1 with the dollar. There was a report out earlier this month by John Griffin and Ammon Shams, who are academics at the University of Texas at Austin, and they lay out pretty convincingly that it appears that Tether might have been printed in the last 18 months to prop up Bitcoin's price and kind of manipulate the market upwards. Tether is co-owned by the largest Bitcoin exchange called Bitfinex, and both Tether and...
Largest or second or third largest?
It changes on the day. Sometimes they're the largest Bitcoin exchange, sometimes they're the fourth largest. However, on their website, they claim to be overall the largest exchange on cryptocurrencies.
Yep.
So I'm just taking their advertising at face value, but on a day-to-day basis, they might be the fourth largest exchange. But this kind of activity is not going to notice. The CFTC started subpoenaing Bitcoin and Tether in December. The Department of Justice in May began its own investigation. And since Griffin and Shams' paper, we've actually gotten other news. Bloomberg today actually noticed very, very suspicious Tether trading on other crypto exchanges that couldn't be explained. People are trading Tether out to like the 5th decimal point. So a Tether, which is worth $1, they'd be trading like 1.15769 whatever Tether, amounts that make no sense. And these were matched on the other side with trades in other cryptocurrencies that seem to push the price of those currencies up and not really push the price of Tether at all. It seems like there's just a lot of suspicious stuff going on with Tether. And the reason why Tether is so important is a lot of the cryptocurrency exchanges can't get access to the banking system. And the reason why is banks, in order to take a client, they have to cover know your customer, and they also have to take precautions for anti-money laundering. A lot of exchanges don't really vet their customers well, and some exchanges allow customers on without any vetting if they come on with crypto deposits and only trade crypto. I know this is a fact for Bitfinex. So what happens is Tether kind of substitutes for dollars for the grease that, pushes the entire market along. Griffin and Shams note that more cryptocurrencies are traded against Tethers than they are against dollars. So if there's a problem...
It's a regulatory workaround.
It is. It's a wonderful regulatory workaround that might be built on very shaky foundations.
Well, ladies and gentlemen, there you have it. We have, we've reviewed the following topics. Passing conversation on West 52nd Street, the future, and how little some of us know, but some of us have actually know a lot about the future. Thomas Jefferson, China, and cryptocurrencies, and debt, and stock buybacks, and the fabulous, irresistible offer to subscribe to Grants.
Now that is a podcast.
Yeah, that's a podcast. So, ladies and gentlemen, thank you one and all, and happy 4th, and we look forward to seeing you again.